For watching. So this is the second stream of the day. I'm back to working on my stock market project. Before I get started, I'm going to go over the goals for the project, what I've done recently, and where I'm at. If you're interested, you might like subscribing. Um, if you're interested in stock market, quantitative algorithms, Python coding, AI coding, generally AI stuff, these are kind of the tools I'm using. So, the project, what does it look like I'm trying to build? So, something like what you see at the bottom here is the framework for my model. So, I have data going back to 2011. You don't want to use all data. You just want to group things that have similar price movements together so you can learn together. So, I'm defining a stock universe. Um, so, my universe that I'm using, for instance, only includes ADRs, which are foreign companies listed on the US market, real estate investment trusts, and common stocks, because these all have similar price mechanics. ETFs, for instance, move differently from these assets. So you need to at least group together similar assets. I'm also excluding everything that's had over a 50% crash in the last year. I'm excluding penny stocks by filtering out everything that's under $5 a share. And finally, I'm taking the remaining top volume stocks. So that's basically what I want. High volume stocks, things that move together. So those three asset classes I just talked about, and no penny stocks. So um, once I have the stock universe, the next step is to generate some model on that universe that's predicting returns. So it should be predicting returns, returns relative to the market, relative to sector, probability of a positive return, um, all of those things. And so, uh, uh, yeah, that's basically that. So I have a really good returns model. I'll go over that in a second. And before I can go live, I need to get a good portfolio model to allocate money based on the output of the returns model. Um, and then once I have a good portfolio model that I'm comfortable with, I'm gonna go live and paper trade for a month every day. And if I do well over the month of paper trading, then I'm gonna go live with real money with the model. So at the top, these are my two goals. So first goal, beat the S&P 500 by a significant margin while staying market neutral. So the S&P goes up on average 6% per year. I want to do significantly better than that, 3 to 4 times better than that, and return on average 18 to 24% per year while remaining market neutral. So the strategy should be robust to if there's a recession or a big rally. It should just reliably give the returns no matter what. Um, and now I'm writing all of this with Python code. So I have the secondary goal, which is that I'm generalizing the code base, and I've put it on GitHub, and I'm updating it every day as I'm making changes, with the idea that anyone can implement this strategy for themselves without having to build up the code. You just have to explore different features and model techniques, universe techniques, portfolio techniques, but you shouldn't have to write any code. That should allow people to more rapidly iterate on their models. So now what have I been doing recently? So here's the model I have, and I got this about a month ago, and here's why I'm confident in it. So the first thing is the metrics you see highlighted in the red box. First metric is information coefficient. That's telling me about the predictive power of the model. And the stock market has a notoriously low signal to noise ratio. So my goal is 0.01 to 0.02. Here I'm getting 0.047, so much higher than my goal. These next four metrics are telling me about the stability of the model. So you want something that has a lot of predictive power, but at the same time, you want something that's really stable. And so the standard deviation of the information coefficient should be 3 to 13 times the information coefficient. Lower is better, and this is 3 times, so about the bottom end of that threshold. Information coefficient to information ratio on a daily basis should be 0.03. I'm getting 0.3. On an annual basis, it should be 0.3, and I'm getting 2.3, so both of those are larger by about an order of magnitude. And then the t statistic, my goal is 1.98. I'm getting 3.75. So again, larger by an order of magnitude. Um, and so this model makes me confident just looking at these metrics. All of these look really good. Um, Now, why else does this look good? So if we look at the decile analysis, this is the hallmark of a beautiful decile analysis. It has everything we're looking for. So first thing, the bottom decile, bottom 10% should be the lowest performing. Top decile, 90% and above, should be the best performing. And it should be monotonically increasing in between, which means each decile is higher than the previous decile. And that's exactly what we see here. And finally, I went through and did a walk forward analysis. So basically created a new model for each year from 2016 through 2025. It's validated on the 3 previous training years and then trained on all the previous data and then tested on the year here. Um, and you see when I did a new model every year, it never goes negative. Even in 2018, the worst performing year, I'm still above my threshold for the information coefficient I'm going for. So for all these reasons, this model looked really good. I went ahead and tried to implement some portfolio strategies on this model. And the first model, which is just a single model, tested from mid-23 through the beginning of 26, it was easy to get a good portfolio return here. Basically, anything I did, I would get a nice, positive, smooth-looking graph. In the worst drawdowns, like maybe 10%, yeah, not even 10%, this looked really good. Now, if you go over here and look, it doesn't look as good. So what's going on? This did really well post mid-2023. This is also doing really well post mid-2023. That's where most of the gains are concentrated. But it went negative from 2016 through the end of 2021. So this is not something I realistically could have implemented. Nobody would sit on a model and keep running it through 5 years of losses. So I would like something that looks better than this. I want it to be positive from 2016 onwards. Now, what's the cause of this? So there could be 2 causes. The first, you see here, this dispersion plot. Market dispersion increased significantly in 2020. That's because the rate of new stocks being listed went up significantly, and the amount of retail trading went up significantly. So there were a bunch of people in the market with a bunch of money that had just been printed out of thin air, and so market dispersion increased. The second thing, obviously, is interest rates. Interest rates were notoriously basically zero from 2010 through 2022, and in 2022, interest rates started to get jacked up. So I looked at the model, the walk forward models, and I found that the decile analyses, while they look good, they're not all perfectly monotonic, and the spread is changing significantly between years. So see here, for instance, 2020, the spread was from about minus 0.06 to positive 0.02. In 2021, it was larger by about an order of magnitude, from minus 0.2 to 0.15. So the spread isn't uniform all years. The monotonicity isn't uniform all years. And so that's not good. So I had to keep looking into how can I improve this model. And actually, I tried dropping out everything that wasn't considered an important feature from the previous walk forward analysis. And this actually looks better. And now you see it is increasing from 2016 through 2020. There's fairly good gains. Then it drops down to about 0, but it's never going strongly negative. And then it recovers after that. And so now my problem has gone from before, where it does well on later times but not well on early times, or I can get it to do well on early times but it does poorly on later times. You see here that this is basically doing well on all times except the COVID recovery. And what's interesting is it is the recovery from COVID. So the COVID crash, it actually does really well, but then in the subsequent rally it does poorly. And so this is just looking around at different strategies. I did get a better model, so I used the same model that I had before, but then I added in sector neutral mean reversion and volatility features. And this is something that had improved the model in the past, and it appears to improve the model here. I tried doing the same exact thing and leaving out the features that were deemed not important, and the performance here actually looks worse. So I'm going forward with this model, Model 25. Um, and now earlier today, I was looking at, how does, if I just do, I have this basic strategy that works well. Now, if I just try to implement some information coefficient scaling, am I able to improve the results at all? And it's been kind of shaky. So um, here's the most recent plot. This is a 252-day look back for information coefficient and a scaling value of 0.01. Yeah, so I'm just trying different values here. So let's screenshot this, put it in. Okay, so let me remind myself. So at minus 0.01, shorter look back was better. Here it seemed like longer look back was getting better. We had these good results with a 60-day look back. Actually, 40-day look back, the drawdown was only 18%. I paid with the Sharpe ratio. I had lower overall returns. Oh no, this was the good one though. 300-day drawdown duration. So since I'm trying to fix this COVID crash thing, I have two goals. I want a lower absolute drawdown, so I was pretty happy with that 18. I don't want like a 25% drawdown. That's pretty hefty. So I don't want that, but I want to make the drawdown period lower, and I also want to make the drawdown lower in magnitude. So let's change this look back to 10 days and use a threshold of 0.02. And so that should be a lot more restrictive. Now, how do I do 3 different series? So in Explorers, let's make a new script. View IC look back results .py. All right, so let's do import pandas as PD. Okay, now we want to say from matplotlib import pyplot as plt. And so I want to make 2 series of plots. One, the x-axis is IC lookback, y-axis should be the value Sharpe or whatever. The next one, x-axis, should be IC threshold, and then different series for the different lookback windows. So this is a lot noisier, a lot more sensitive to drawdown, so the gross exposure looks a lot noisier. Oops. Alright, so look back 10. Threshold is now positive 0.02. So let's try a look back of 20. Hey, NASCAR. I like ADVB for a potential move tomorrow after the bell. I don't know. What is ADVB? Alright, so let's run this again. ADVB stock. Market cap 7 million. I don't know. I'm not touching this, man. What do you like about it? Look at the volume. Where's the volume? Oh, it doesn't show the volume. Anyway, the price to earnings ratio is 1. I don't know, man. It looks like it's going to nothing. I guess it's just been listed for the last year. Biomed. Advanced Biomed. Seems self-explanatory, right? Doesn't give any summary there. Okay, so the so this is pretty consistently bringing it down. How did it do over 2020? So it dropped from 60% profit down to 20% profit. I don't know. That's not significantly better than I've been getting. Okay, let's make it a 40-day look back now. Last week we had HTCO, RDAC, and AIOS all run after the bell. I just think the price action volume profile very similar to AIOS. 250% in one day? That seems crazy. Whoa. Well, that's not... Yeah, that is. Whoa. So from Friday at the bell to the peak on Friday, it went up. Whoa, in an hour and a half, it doubled. That's pretty crazy. Okay, so now we want to run this at 40 days. Okay, and let's put the results in. So for 10-day look back, threshold of 0.02. And for 20-day look back with 0.02 threshold. So 10-day we're getting 1.5 for the sharp. Max drawdown 25.8. Drawdown duration 460 days. So pretty bad. Average annual return 25%. When we extended it out to 20 days, we got 1.42 for the sharp. Max drawdown 27%. Drawdown duration 457 days. Average annual return 25%. So for the past 4 years, I've tracked every 250% intraday runner. You start to get a feel for what the sympathy plays will be and see the current trends in the market. That's pretty interesting. So how often does that happen? How many times this year has there been a stock that goes up 250% in a day? That looks really good. So higher return. Whoa, drawdown duration under 300. We did get that here. Sharp 1.55. Max drawdown only 22%. And let's do this also at 60 days. And let's look what happened during COVID. Because it looks not bad. So it peaked here at about 73% returns, dropped all the way down to 40% return. Yeah, that's not bad. Short drawdown duration. If you force me to say what ticker will be the biggest gainer tomorrow as of now, I'd say ADVB. Wow, there have already been 9 10x stocks this year. So how do you predict that? I always feel like there must be some like core fundamental story going on that's driving that price movement. All right, here are the look backs 20. Here are the look backs 40. And so let's try look back 60. I see threshold. .02. Sharp 1.55. Max drawdown 22%. Drawdown duration 297 days. Average annual return 26%. So also at 297 days was 10-day duration, 0.001 threshold. That had a higher Sharp. Same annual returns. Higher drawdown. Okay, here are those results. So back to a higher drawdown duration. Back to a higher max drawdown. Sharp ratio is about the same. What the hell? In 2025, there have been 776. 2026. Bird on 415 was the last legit 10x runner. The PR was press release. Oh, yeah, I heard about Allbirds. People were talking about it. So they went 10x, huh? So let's get the data. df equals pd.read Excel. Sheet name. So read Excel. Portfolio. .xlsx. Sheet name is equal to IC scaling results. Let's put the date 5/3/2026. Alright, so now let's say, just pull in a debugger. We could look around with this. Import open pixel. Bird ran 1000% 3 hours. Oh my gosh. That's crazy. Sheet name, IC scaling results, 2026-0503. IC scaling results, 2026-0503. So let's see. The first thing is do a different series for each look back range. Yeah, so I'll start with that. So for look back in df of IC look back dot unique I'll say actually threshold. Okay, then we want to plot set the fig size to be, just say 9 by 5. So axis sharp is equal to fig dot add subplot yeah, I'll just start with this. Fig dot add subplot, so 1 row 3 columns, number 1 AX drawdown is fig dot add subplot, 1 row 3 columns, number 2 at AX DDD drawdown duration is fig dot add subplot, one row 3 columns, number 3. Then we're going to get the data for the threshold. For, let's see, we want to iterate through the rows. All right, so let's just say C equals 0 for row in data dot no, I'll say for sharp. So we're doing each threshold. So for look back, sharp drawdown duration in zip data of IC look back dot values. All right, so that's the first thing. Next thing is data of sharp dot values. Next thing is data of max drawdown dot values. And then finally, data of drawdown duration. All right, first we'll do c plus equals 1 at the end of the loop, and then we'll say label is equal to if c is equal to 0, else none. And then here we can say and then for axis val and zip sharp so zip axes, then vals. So ax sharp, ax dd, ax triple d. And then we have sharp, drawdown duration. We're going to say ax dot plot, ax dot scatter, so first we're going to scatter the look back, then val, then label is equal to label. So let's say for symbol, color, threshold in zip, symbols, colors, then these guys. So how many different thresholds do we have? Minus 0.01, minus 0.001, 0.01, 0.02. So 4 thresholds. So symbols is equal to square, circle, big diamond, and upwards triangle. Colors are equal to green, red, blue, and orange. And then when we scatter, C equals color, symbol equals marker equals symbol. Yeah, let's just see how that looks. Alright, so here's the results. We could definitely make this wider. So the drawdown, this is chaos. So this guy had the reliably lowest sharps. Yeah, I don't really know what to make of this. Maybe I'll add on. Okay, so look backs. sharps, drawdowns, drawdown durations. This is chaos. Yeah. I don't know what to conclude here. Other than, I guess we could say, longer look back with a stricter window seems to do better. Hey, Chris Sabyadov. I don't know. Just watch the streams. Check out the GitHub. Try out the code in there. So nothing, no obvious trend of improvement. Seems like the pink line, I guess, is marching down in drawdown. Yeah, I guess we could look at 0.02 with what, 100? Maybe it will be low again. May as well try it. Yeah, so that optimization earlier didn't do very well. So I don't know if I should redo that or yeah, I'm gonna have to redo it, I think. Find some better way to implement it. Yeah, I don't know. So there's nothing clearly improved anything here. That low drawdown duration was happening anyway with just the volatility scaling. Hey, Sir Night Night, how are you? Well, I'm looking through earlier today. I did an optimization here, but I didn't do a good job of saving things, so I'm gonna have to redo this. But I'm basically looking into how to improve this strategy, which honestly doesn't look that bad. The one problem period is COVID, but it's really not that bad. Um, Here, I could run this again. Okay, this one actually just finished. So yeah, 413-day drawdown. Worst drawdown 26%. So this isn't any better. Um, but basically, the one problem region is COVID. So it does really well, runs up to like 70% profits, drops down to 30 some odd percent profits. Um, but I think next I'm just going to try manually tweaking these scalars. So you see, information coefficient tends to be bringing this down, which is fine, but I need something to drag down the exposure during 2020. So the exposure was lowered during this year. Hmm. Yeah, I don't know. I need something a little more sensitive, I think. Anyway, then I was looking through how to. I was trying to see this good strategy I had. top left. I was trying to see, can I change the parameters to bring the drawdown, the scale of the drawdown lower, and or the drawdown duration lower. And the drawdown duration I wasn't able to improve on. The magnitude of the drawdown I was able to improve on, sort of. Um, yeah, there's kind of a trend here when I'm using. Oh, this is positive, so 0.02 is in the middle, 0.01's highest. Um, so if I used minus 0.01, I actually did pretty well in the drawdown this first year. Yeah, so minus 0.01 with a 10-day window. Have you tried reversing your logic when volatility reaches a certain point? No, you mean basically volatility reaches some threshold and then scale back up. Basically scale up when volatility's high. Oh, you mean inversing when volatility... So you're saying volatility hits high enough and then go short on the longs and long on the shorts? No, I haven't tried that. That could be interesting. So what if I just start punishing the drawdown at 0.1%? Or sorry, 0.1, so 10%. And say, let me just try that with the good strategy. So, IC scaling, let's turn off. Yeah, what you mean? Nice chart in terms of the information or that drawdown chart? I like that one. Or do you just mean the returns curve has a nice shape? So let's make the drawdown threshold 0.05. So over a 5% drawdown, cut exposure to 50%. And scaling's off, yeah. But it seems like just talking to the model, it seems like if I'm relying on volatility to scale the exposure, that's an indicator that the model's not robust. That's what the AI tells me. I'm not sure exactly why that is. Although I do understand it seems what seems most robust is if I just scaled from internal parameters, scale from the information coefficient, scale from the spread, don't scale from anything else. Ideally, that would give me a nice strategy. I'm just having trouble doing that. Maybe I could do an optimization. So So the drawdown does seem like it's a little less here. Drawdown duration is longer, so I'm cutting the exposure you see here. Oh, it's just penalizing drawdowns more intensely, actually. So what if I change the drawdown warning threshold? It's set it at 0.1, but make it more intense. Scale it down to 0.2. Let's see what happens. Well, no, I agree. There's no need to scale exposure, but if I'm not scaling exposure, Yeah, okay. I think I should use volatility index too. But the problem basically is that if I'm not scaling exposure, the strategy doesn't do very well. Um, Maybe I should focus on that though. No exposure scaling. So that's kind of two things to try. So let's say in the last year, let's accept volatility of 1. And how does it do? So that should be drawdown warning threshold -1. And then it should just be max exposure the whole time. Whoa. Well, that seems like I'm getting an improvement on COVID. So I dropped the exposure down to 0.2 and there's a big drawdown. That hurt me in these early times. Max drawdown duration's still long, but it's not as negative. It's not really that much better. So let's see what happened during COVID. But ideally, I could use like the spread scaling to account for that. Because the spread also dropped during COVID. And really, the big drawdowns here, it really dropped from. This might be an improvement. Dropped from up 97% really to here. Beginning of 21, up 64%. So that's not bad. So what if I'm just penalizing below 0.01 using a 20-day look back, and spread scaling let's turn on. You mean the spread of the model? Yeah, I do have that. I haven't been messing with that, but I'm gonna start right now. And if spread is at its lowest in the last month and a half, still deploy 40% capital. So 0.2. And why not use a long look back? If it's the lowest spread in the last year, drop it way down. Spread might work. I'm thinking it could cause a bit more turnover than you want. Spread expands for multiple reasons, not related to fear in the market. It should hurt the longs. So you think a higher spread means the longs are performing worse? Or lowering spread will improve the longs? Okay, so here's the results. No volatility scaling, only spread and information coefficient. So the spread isn't drawing it down that much. It does in early times. Or no, the spread is dominating. So let's see 2020. So first, 2020, March, nothing's dominating. I really feel like I should multiply the scalars. So what if so no, I'm not z-scoring the scalars. Probably I need to read more. So let's see if they have scalars in here anywhere. Yeah, I don't know. I don't see it. Z-scoring the scalars might be a good strategy, though. All right, so what's affecting the drawdown? So first, the spread's pulling it down. So the spread should be less extreme. Okay, so tomorrow I'm gonna go through and try to do some optimizations um, using only these scalars. And then I'm gonna z-scoring the scalars is a good idea. Um, VIX, flip, buys, and sells. Okay, so that's it for tonight. I have some things to work on for tomorrow. Thanks for watching. I work on this every day, so don't forget to subscribe if you find this project interesting. Adios. Have a good night.